Class, I wanted to clarify some confusion that I think is arising between a product portfolio and the BCG matrix. A product portfolio is simply the collection of products and brands that are manufactured, marketed, and sold by a company. A BCG matrix is a way of analyzing a company's product portfolio and placing them into certain quadrants based on their current market share and on their potential growth rate. A product portfolio is important not because it can determine decisions on whether to invest or divest in a product or in a business, or because question marks can become stars and cash cows can fund question marks. Product portfolios are simply just a collection of products. The BCG analysis places the collection of products a firm has into one of these quadrants. So a product portfolio is not important because of all of the elements that are a result of a BCG analysis or the BCG matrix. A product portfolio is important because it gives firms a collection of products, because some of these products will be dogs, which means they are not going to make you any money. Some of these products will be cash cows that will fund research and development to generate new question marks or new stars, or to fund the movement from a question mark into a star category. Additionally, products go through a life cycle. This is something that we're going to study a little bit later in the course, but a product life cycle basically goes through multiple stages. The first stage is the introduction of the product. The next stage is growth. The next stage is maturity. And the final stage is decline. During the introductory stage, expenses are high and revenues are lower. During the growth stage, expenses tend to drop and revenue starts to increase. And we talk about expenses, we mean expenses per unit. In the maturity stage, revenues remain flat, while costs continue to rise again. Whereas in decline stage, revenue tends to go down. Because of these different stages of the product life cycle, in order to be successful, a company needs to have multiple products in multiple stages that would offset the maturity and decline of one product with the introduction and growth of a second product. That way, they can help to stabilize or even grow their cash flow and revenue. Otherwise, without multiple products, the company would be subjected to the whims of the market. Within the maturity stage, there are more competitors than there are during the intro or even a growth stage. So as more competitors enter the market, the likelihood that revenues will decline because of price competition and costs will go up in order to acquire and keep new customers. If you only had one product, once that product started to go into decline, you would no longer have a business. So you need those multiple products for, number one, to offset the loss in revenue of older products, and secondly, to ensure that you will stay in business once your first product starts to decline. We'll call that business continuation or continues. I hope this helps to clarify some of the confusion that you may have had between these two terms and topics.